So welcome everybody. Good evening and or morning or afternoon, depending on where you are, because we are continuing our international speaker tour after having our first in-person meeting last month. So John probably doesn't know this, but we've been doing these Zoom webinars for a while, and we finally managed to have like an in-person meeting. Everyone got together, we got to have drinks, and that was last month, which was great. But now we also get to have the benefits of the International Speaker Tour. So today, of course, we're speaking with Mr. John Bollinger. So John, welcome.
Oh, my pleasure entirely. I'm sorry I wasn't there for the in-person meeting.
Oh yeah, well, next time you're in London, let us know, and we'll get you along and show you a good time, I'm sure. So a couple of just housekeeping things before we sort of kick off here. Questions are encouraged as always, and if you recall from previous Zoom meetings, the easiest way to do that in this format is with the Q&A box right at the bottom of the Zoom window there. If you put things into chat, they might get lost because it's just a little bit too much to manage. But the Q&A means that I can try to manage it, and then Katie gives me a hand with that as well. So any questions, Q&A, drop them in any time, and I'll do my best to work in as many as we can. So our international tour today, John is speaking to us, of course, from the States, but he's speaking to us from just south of Santa Monica, if I remember right.
On the Pacific coast here.
There we go. So it's only 10:30 in the morning to John, and it's 6:30. I lost a couple hours here in London. So welcome to wherever you are. John, I thought maybe an interesting place to start today would be FNN, the Financial News Network. This is going to go back a few years, but I'm curious about a few things on FNN. Could you tell us a little bit about what FNN was and what it became and what you were doing there?
Well, FNN was the Financial News Network. It started out as a network, a cable, an over-the-air television network using those very high number television stations. In the States, the regular stations run 2 through 13. And then up above there, you have very, very small stations with low capacity. So it started out as on 5 of those stations: Chicago, Boston, Los Angeles, Washington, and someplace in Florida. I can't remember where. And it eventually morphed into being a cable network, maybe 6 or 7 years after it was created. The Financial News Network was a live market analysis network. I think it was founded in 1978. It was the predecessor to CNBC. When I got there, which was in 1984, it was already both over the air on those 5 stations and a very large cable network. And they hired me to bring on technical expertise. The chairman of the company was a guy by the name of Dr. Earl Bryan. And in college, he had discovered and fallen in love with technical analysis. And since he had some operating companies in the medical area, he had access to some early microcomputers. These were digital equipment computers, VAXs as we called them. And he had written an entire suite of programs, technical analysis programs, and they had an early data feed and such like that. And he thought that the content of the air on FNN was lacking in technical analysis, so he wanted to integrate that programming into the on-air content, and that's what I was hired to do nominally. And it was very successful. After a year or so, there was a lot of technical analysis content, and there were a lot of technical analysis guests. We made a huge effort to bring people in. We had studios in LA and New York, but we made a huge effort to bring people in from wherever they were around the country into our studios to talk to them. So over the 6 years I was there, I would say that, I talked to probably every important market technician operating in the States, to some extent Europe, and to a lesser extent Japan, 2, 3, 4 times at least. And many of them we arranged regular weekly slots so that they could, give their technical outlook on a regular basis. Those included people like Larry Williams.
So, I'm curious on a few instances there, because I think now you were already in California at the time, I presume.
Yeah. Hold on. I just happen to have this is the manual for the computer program that that Earl Bryan had written, and that became the backbone of FNN's coverage.
Wow. And you keep the manual just in case you need to reference it for, keeping it going?
History is really important. As you can see, there's a lot of books behind me, but that's just the beginning. There's
oh yes,
many more, and that's only one set of the bookshelves.
Gotcha.
So yeah, I have a huge technical analysis research library here.
Fantastic. So, but now FNN was based in California, right, on the West Coast?
Yeah, it was in Culver City. It was in the old Douglas Aircraft Photo Plant, which was a lead-lined building. We all loved that idea. Yeah, and there was no money, and we all did it for love. The interesting thing was that management didn't really know anything about the markets, but the staff knew a lot about the markets. So we were really able to drive content. And as long as viewership was up and rising, which it was virtually the entire time we were there, they didn't interfere very much with the programming. It was really unsupervised play. We got to do whatever we wanted to. It was really, it was a great time for financial reporting, because we covered everything from fundamentals to technicals to news to background events, and we covered it on an international basis. It was a really special time.
I find it interesting that it was West Coast based, because that's a pretty early start for you guys. You must be a morning person if you're following sort of the U.S. markets on the New York Open.
Yeah, that's true. The bonds used to open at 5:20 in the morning back in the days of Paul Volcker and Alan Greenspan. You know how important that was. So we would all be up and bleary-eyed for the opening, as it were.
It sounds like some great camaraderie. There's actually somebody who's just posted something in the Q&A. It says that you used to appear on his show, Stock Options and Futures on FNN, with Ira Epstein.
Yeah, that would be Ira Epstein.
Yes, yeah. So I was tuned in with us today.
Yeah, there you go.
Excellent.
As I said, we had, virtually everybody in the business came through the studios at one time or another. Many people had independent shows. There was a big area of programming that was the main slug of programming, which we did ourselves. But in addition to that, there were a number of independently produced shows.
Right. Fantastic. Now, I'm sure everyone is curious, and I am myself, and I've heard some rumors. But you, of course, are best known for Bollinger Bands. And I get the impression that was developed probably around that time when you were at FNN, or maybe even earlier. Could you tell us a bit more about the origins of Bollinger Bands, and then specifically the naming? Was that done organically? How did you come on the name of Bollinger Bands, or was that an accident?
Well, we'll get to the name in a minute, because they went without a name for a long time.
Okay.
they in the old days, we used percentage trading bands. It just you take a moving average, typically a 21 period moving average, and you'd shift it up and down by some percent to form a channel, a set of trading bands, and you use those to define whether prices were high or low on a relative basis, and you would use that to inform your trading decisions. The problem with that is that over time, the width of the bands needs to change, and it has to change from issue to issue. And in doing that, in setting the width of the bands, you let emotions into the trading process. You set the bands. If you're bullish, you set the bands to produce a bullish picture. If you're bearish, you set them to produce a bearish. You understand. Anytime you have to specify the parameters on the fly, your emotions are going to get in the way. I was an option trader at the time. This was in the very early 80s. And I was looking for a way to automate setting those bands so that I didn't have that input. And I had a very early microcomputer running the old CPM operating system, but it had a spreadsheet. It was called SuperCalc. And I would do my options calculations, my volatility calculations in that spreadsheet. And one day I copied the formula for volatility down a column and noticed that it was changing over time. Now, at the time, we believed that volatility was a fixed property of a security, like the house is blue or the car is red, something like that. We didn't understand that volatility was volatile. Of course, we understand now. And then, to cement that, a paper which ultimately got a Nobel Prize observed that volatility on economic data was volatile. That prize went to Robert Engel just about that time. So that idea was in the air, that something about our understanding of volatility was wrong. We weren't exactly sure what it was. And I saw it changing in that column, and I said, maybe I can use that. Maybe I can use volatility to set the width of trading bands. And that's the genesis of Bollinger Bands.
Fantastic.
The naming is an entirely different story, right?
Okay.
An entirely different problem. I didn't name them maybe, I don't know, for a few years. And one day I was being interviewed on air. I was a pretty bad presenter in my first couple of years at FNN, but I was a pretty decent interviewee. So Bill Griffith would often interview me, say a couple times a day about what was going on from a technical perspective. And one day I put up a chart with these trading bands on it. And Bill said, "What are those?" And I said, well, let's pick the obvious name. Those are Bollinger Bands.
Right.
That's how they got to be Bollinger Bands.
And it sounds like it must have stuck, because
it stuck instantly. And one of the things that I did that was really interesting, I was at that stage of the game, technicians were really into sharing with one another. There was no internet. There was no, so whenever you saw another technician, you'd talk about your tools and techniques and what you did. And there was a lot of sharing, right? So I understood intuitively in this open source idea back then, because technicians really were open source back in those days. Maybe you had to buy the course or something like that, but everything came pretty much fully disclosed.
Right.
So I put Bollinger Bands in the public domain right from the get-go because I wanted to share them, basically to give back for all that had been given to me as I learned technical analysis, learned how to trade in the markets and such. So Bollinger Bands have been in the public domain since basically a couple of years after their inception.
Fantastic. And I know that everyone's benefited from it. I was going to say earlier that, I'm not sure you can call yourself a technical analyst if you don't know what Bollinger Bands are. And and of course,
how amazing is that?
You mentioned that when you were first sort of developing them, you noticed the volatility changing over time. Were you using standard deviation as that mechanism right from the off? When you were
I was using standard deviation because that's what options traders use, but I explored all of the measures of volatility that I could think of at the time. I mean absolute deviation, standard deviation. I looked at a couple of the one-sided ideas that would later get names. And so so this gets to the reason why Bollinger Bands work. Standard deviation has a little bit of magic inside of it. Standard deviation takes the deviations from the average and calculates and uses the deviations of the closing price from the average price over that period of, say, 20 periods to figure out what the volatility is. But if you just take the deviations and sum them together, it collapses to zero because it is the average, right?
Right.
So standard deviation squares the deviations to get rid of the negative signs, and that's the calculation mechanism. But that has a very special property, because if you square two small numbers, you get another small number. Right. But if you square two big numbers, you get a really big number. And so that meant as prices departed from the average, the bands would adapt very quickly to stay in touch with the price structure. We say that our definition of relatively high and low would remain germane to the price structure, driven by this squaring of the deviations. So if you got a big gap up, the bands would adjust very rapidly to the new price structure, and that's what made them work.
Yeah, I totally understand. Because the alternative, or an alternative, I should say, because there's many bands, of course, right? But if we were to compare it to, say, something like a Keltner channel, where it's based on like an ATR or an average range, that tends to remain fairly fixed over time. That doesn't adapt as quickly. Whereas Bollinger Bands with the standard deviation element will adapt very quickly.
And a lot of people use that difference in the bands as a trading tool. So people draw both Keltner and Bollinger Bands on the same chart, and when the Keltner bands are outside of the Bollinger Bands, that gives them one set of information. When they're inside of the Bollinger Bands, it gives them another set of information. So they adapt their trading opportunities, their trading approaches based on the relationship of Bollinger Bands and Keltner Bands. And that's a great idea.
Yeah,
and that's also a very old idea. I think that probably started in the very late 80s or the early 90s. People started to do that.
Right. Yeah. I've certainly come across that myself before. Like a squeeze when inside the Keltner channels, as in when the Bollinger Bands are inside the Keltner channels, and then looking for an opportunity for a volatility breakout.
Yeah, and people also use that to adapt their trading methods, for position sizing and such like that. So
certainly, one thing that we discussed just briefly yesterday when we had a pre-chat was the adaptability when some of those bars fall off of the calculation, right? So you can one of the things, especially prevalent with gaps, is that the gap will cause the bands to do this little bubble, as I often call it. And then once you're, say if you're on maybe an intraday chart as well, you get a large gap up, and then you'll get this large expansion in the bands. And then, of course, once you've done however many look back bars for your Bollinger Band session, say 20 for the default, now all of a sudden you're on today's data, and it all readapts to what we're looking at currently.
We call that the takeout value problem, and it was known for years and years. I think it was first observed in calculating averages of breadth data, advances and declines in up and down volume. Maybe in the 70s or earlier, its technicians started to talk about that. So it's both a problem and an opportunity, because it does cause the bands to adapt as those big changes move to the back of the window and fall out of the calculation window. But it also allows you to pre-calculate what the band values are going to be the next day. So it gives you an opportunity as well. There's a way of getting around that entire issue. and that's to use exponential Bollinger Bands, using an exponential moving average and using exponential standard deviation calculations. That way you can avoid the entire issue of takeout values. Some people really like that. I don't use that much myself, but I did create and publish that, I don't know, 25 years ago or so, for people for whom that was a concern.
I was going to ask you about that, about the selection of the average, because it's a simple average by default. But of course, if you use an exponential, it does adapt that bit quicker. And is it, for simplicity, just the simple average is easy enough?
We did things by hand back in the day.
Right, right.
So simple moving averages, they're easy to calculate. You take the difference between the takeout value and the incoming value and add it, divide by 10 and add, bang, you've got the new number. So I'll show you something here.
Great.
I just saw this. Here's that. This is in fact how we used to do it.
Oh, okay. Here we go. So, so talk me through. Is the time series going down vertically?
Yeah, daily. It's daily. So just going across, it's the Dow Jones, the 12-day rate of change, the 24-day rate of change, the tick, the trend, exponential smoothing, the S&P index, the futures, the premium, the OEX, goes on and on and on.
Wow. And so were you calculating those manually at the time and filling them in once a day?
Hourly sometimes.
Wow. And did you graph them as well to get that visual? Stupid question, right? There we go.
So this is actually an interesting chart. This is the Dow, the S&P 500, and the S&P 100 all rescaled so that you could compare them.
I see it. Yeah. That's very interesting.
So that's how we used to do it.
Yeah.
It's a shame that we don't do that anymore, because it gave you a certain tactile feeling for what was going on. When I develop something new, I try to calculate it. If it's not too complicated, I try to calculate it by hand and graph it for a little while. It just gives you a better feeling for how the numbers, how your formulas and functions interact with the data and what the outputs are like. Especially important over volatile periods. So I'll often go back and select a very volatile period and calculate it for that by hand, just to try to get a better feel for what's really happening with the calculations.
Yeah, the closest I come is manually calculating things in Excel and just monitoring them sort of day by day or bar by bar. It's close.
And of course, that's how I do it 98% of the time now.
Right. Right.
I'm also a big Python user. I really love Python. I think it's for technicians. I think it should be the language of choice.
Yeah, I think you're probably right there. We're using that a lot ourselves these days. And there's that whole open source mantra that you mentioned earlier is really active in Python, and you can somebody's probably done it already. Whatever it is you're thinking of doing, someone's probably done it or solved the problem, and then you can try to be creative with whatever you're thinking. But
yeah,
it's a fantastic tool. If we take a step back for a second, I found it interesting just going through a little bit of history that we at the STA, of course, are very aware of you and your work, and I'm also aware that you were very active for a while in IFTA. I think you were on the board of IFTA for, what was it, a number of years, and the MTA and the MTAEF.
I was on the board of the MTA for 10 years, the board of IFTA for 5 years, and the board of the Education Foundation for 5 years. So I put in 20 years. I'm done. Thank you.
Yeah, I think that's.
If anybody's out there thinking about asking, I've done that. I had a great time. I learned a lot. I met a great number of really wonderful people. And I'm very, very pleased to have done that and to have contributed in that way.
Yeah, I think it's a great way of certainly networking, meeting people, and then sharing tools and experiences. I noticed that and I think I read that you were one of the first who had both the CMT, as in like one of the U.S. technical analyst qualifications, and the CFA, which is sort of like the fundamental qualification.
Yeah, I am in fact the first. The first CMT test was given in Camelback, Arizona. There were 30 some odd of us, and I was the only CFA, so I am the first by default.
Right. Very cool.
Right. I mean, it wasn't an accomplishment; it just happened that way. Since last time I checked, there's somebody at the MTA who keeps track of such things, and I think there are a couple of hundred of us now, maybe several hundred of us now.
Right. So
I'm CMT 13.
CMT 13. I don't know what the 13 means.
Just a number, the serial number.
Oh, I see. So that is your sort of like, you were the 13.
They did it by lot. They took I think 32 of us passed that first test, and they put the names in a bucket and drew them so that nobody could claim to be number one. Or
you got lucky number 13. That's great. But so I guess you've got a backing in not just the technicals, which you're clearly gifted at, but you've got a backing of the fundamental side as well. And then through going through some of your other works, I'm sure everyone knows you for the Bollinger Bands, but there's loads more to the amount of work and the amount of analysis that you put out there. And specifically, you kind of wrap that up into something that you called rational analysis, which was sort of that Venn diagram crossover of the fundamentals and the technicals, if I understand it right. Can you tell us a bit more about that?
So, I didn't have a background in finance the way, people coming in now do. I hadn't studied finance in school. I was actually, I came from the movie industry. I was a cameraman in the movie industry before I worked in finance. So sitting for the CFA was really terrific for me. It gave me a very broad base of knowledge, equivalent, I think, to taking an MBA in finance. In those days, there was one exam a year, so it took me 3 years. There's 3 parts to it. And I was already very strong in technical analysis at the time. And it just seemed to make sense to me. There were certain things in fundamental analysis that seemed to add value. There were certain things in technical analysis that clearly added value. And I thought that by combining them, the analogy I like is if you worked in a garage and you had several toolboxes that, against the back wall, each one painted a different color. Well, if your uniform was yellow, would you only use the tools in the yellow toolbox?
Right.
Or if there was a tool you needed in the red toolbox, would you go use that? Well, of course you'd go use that. So that's what rational analysis is. It just says, if there's some something that can be added to deliver, better results to our clients, why wouldn't you add it? I think IBD has really been exemplary in that regard. They stressed the relationship between relative strength in earnings and relative strength in price, a fundamental measure and a technical measure. I think that I think that work is right on. I think that's really important work, and I think you can. Some technicians go, no, if it's not technical analysis, don't talk to me about it. And many fundamentalists have the same attitude in reverse.
Right.
If it's TA, it's trash. But I think we should keep open minds. A closed mind doesn't work very well.
I totally agree. Yeah, I think the crossover is beneficial for sure. And yeah, like you said, is the right tool for the job, right? Go and find the right tool and then layer those tools together.
Yeah, it doesn't mean you have to use any specific tool, but if you need a piece for that program, go for it.
So I was reflecting on your book, Bollinger Bands, the other day, and I picked up and just reread some of the introduction there, and I'm going to put you on the spot here a little bit because it seems like you were saying that particular book would be very specifically sort of geared towards Bollinger Bands, and that there may be another work at some point that describes a bit more about rational analysis. Not coming. Fair enough. Was that something you considered?
The bottom line is to write that book would take a couple of years of my full effort, and I simply don't have it to give it right now. I'm running a successful investment advisory firm. We're developing new products and we're serving clients, and that's what really makes me happy. And taking a couple of years out to write a book and putting all that effort in, it just doesn't fit in with my plan right now.
I totally understand. It did seem like you were maybe considering it though at the time of writing the first book.
I did, but I had a really unfortunate experience with my publisher, and it soured me on the entire idea of being an author.
Okay.
I can't. I don't wish to elaborate, but I just never wanted to write another book. I do have about 85 or 90% complete a study guide and a small addendum to Bollinger on Bollinger Bands that I hope to finish maybe early next year, but that'll be the end of it.
Fair enough. Understood. It's now I noticed that Bollinger on Bollinger had sort of like a website that went along with it. And that is still active currently, isn't it? As it's a screening and a service where like some of the work is done for you if you follow some of those concepts.
Yeah, it's bollingerbands.us.
Okay.
And it's actually created by an Italian partner of ours, TraderLink. We've done a beautiful job with it. And it has, the full suite of Bollinger Band tools and a lot of screening and listing and such like that.
Fantastic. If I change tack here a little bit, one of the things that impresses me most about yourself is not only that you've got the technicals and the fundamentals under your belt, but that you put your money where your mouth is, right? You are not just, I say just an analyst, but you are not only an analyst, you are also a trader who are using the tools that you develop and putting your money behind it all the time. And that's one of the things that I greatly respect. And so I'm curious.
That came in the opposite direction. I started as a trader.
Right.
And so I've never, never lost that love. And I think it's really, it's really been really important to the success of our investment advisory to bring that background in trading.
Yeah, certainly. So did you start trading? Was it in options and therefore in option pits at the time?
So I actually started. I started trading in the late 70s. My mother, who was actually the first woman executive on Madison Avenue in the advertising business, had left the major firm at Madison Avenue and started up her own small ad agency, and was getting ready to retire. And she was getting really poor advice, really poor financial advice. And she knew I was interested in stocks and followed stocks and such like that. So she asked me if I would take care of her retirement funds. And I very reluctantly agreed because I didn't really have the background to do so. So I started with brokerage research reports and the typical fundamental ideas that people use and failed miserably with those tools, and started to introduce TA and got better at that. And then I started picking up options trading, mostly for myself. But I did some option strategies for her around stock positions, trimming risk and adding and subtracting stock positions. So it was an organic process that over a period of 4 or 5 years, where I went from being a cameraman in the movie business. One day I woke up and realized I had taken a job in the movie business for a year. So I figured I must be in the finance business.
Fantastic. And so at what point did you start your investment advisory firm? Or was that just sort of an organic extension of what you were already doing, and a few people were hounding you to say, could you manage some money for me?
It was, but the real event was General Electric bought the Financial News Network and put it out of business, and we gave most of the intellectual property and some of the anchors and some of the talent to CNBC, and they offered me my job back in New Jersey, but I'd moved from New York to California and wasn't anxious to move back east. So instead, I hung out my shingle with Bollinger Capital Management in 1990.
So roughly 30 years then in the business. And
yeah, I helped CNBC with the transition for a couple of years, both providing content and helping them integrate technical content into their on-air material. For example, we had created this premium calculation that was so popular at the time. So I helped CNBC implement that and some other technical analysis information boards and such like that. They had it.
Fantastic. I think it's great that the firm is still running, and that you've just carried on doing what you do, over the last 30 years, and somehow in there you managed to write a book.
Yeah. It's actually running stronger than ever. I only wrote the book because people hounded me so much about it, and writing the book was actually pretty interesting because, I had to delve deeper into some topics than I had delved before in order to really be able to write about them cogently. So I learned a tremendous amount about writing, about trading and analytics and such like that by writing the book. So it was a fantastic experience for me. If I'd had a good relationship with my publisher, I probably would have continued. But that's water under the bridge.
Sure. Maybe I can ask you a bit more about the bands themselves and maybe some of your favorite uses of them. I'm peeking through some of the questions that have been coming in, and people seem to be pretty curious. So could you share with us maybe what your favorite approach or what's your favorite use of the bands from from an analysis setup or a trading setup?
Well, all trading bands are similar in a way. They provide a relative definition of what's high and what's low, whether that's percentage bands, Keltner bands, Stark channels. There's all kinds of bands and such out there. But that's what they do, but that's incredibly useful information. For example, you can define a W bottom in a stock by the fact that the left-hand side is outside of the lower Bollinger Band, the right-hand side is inside the lower Bollinger Band. But the whole idea for me is to find opportunities in the marketplace where the odds of your success are high, that is a winning trade versus a losing trade.
Right.
And also, very importantly, that the amount risk is much smaller than the potential gain. Of course, one can never know what that gain is going to be, but one can estimate. So when you find a trade in relation to the band, say a W bottom, very popular and I think very useful trade, where the odds of your success are 60 or 70%, and you have to risk, say, 3 or 4 units in quest for 15 units or something like that. that's this, the sort of stuff that long-term trading success can be made of. So if you add another little bit, if you instead of taking the signal the day that it occurs, if you wait for confirmation, if you wait for price to confirm your opinion about the market, then you can really have a successful trading approach. So I'm very, very fond of trading bands. I use other approaches as well in our work here. I'm a big fan of relative strength. I'm a big fan of industry group and market sector analysis. So we're not a one-trick pony here, but where trading bands come, the moment I saw them, probably 78 or something like that. Somewhere's in there, I saw these percentage trading bands, and the moment I saw them, I knew it was the right idea. I mean, I knew that that was the key to the empire, as it were. It turned out to be correct.
Well, I got to tell you, one of my favorite trading setups is very similar to that W bottom, or sometimes we call it a lazy W. Where that
a lazy W.
A lazy W. That's that's one that comes from a very close friend of mine, Dr. Ken Long. I mentioned to you briefly on an email ahead of time. He's built a framework called the Rlco Framework, which is based on multiple bands sort of layered on top of each other. And I know the phrase from him. I don't know if he originated it. The lazy W essentially means that you have, let's say, a bottom, and then the next bottom is just higher than the previous bottom. So it's a higher low, and it's sort of like the first higher low.
So I do that, but I don't do it in absolute terms. I do it in relation to Bollinger Bands. So in fact, I like it a lot when the second low is actually lower than the first low.
Oh, okay.
Right? But not a new low in relation to the Bollinger Bands.
Understood.
Right. So that's actually my near ideal pattern. I think that's because on the second low you've scared the remaining sellers out of the market. I'll point out something about your friend Ken Long. Is that his name? I looked at a couple of his charts, and one of my favorite classic technical analysts. I don't need to hedge that. My favorite classic technical analyst is Richard Wyckoff. And several of the ideas that he was talking about would be intuitively correct to people who have studied Wyckoff. So I really like that. I like when you look in modern TA approaches and such like that, and you can see the classical antecedents of those approaches in play, and you know that there's a better chance that you've got something really robust on your hands.
Yeah, for sure. And I think when you realize that it all kind of comes back to the simpler concepts as well. So it's simple things like higher lows, for example. It doesn't have to be a higher low, but geez, I like a higher low, right? For trend confirmation. So do you a question about other derivative works then? There must be, I don't know how many, there must be hundreds, thousands of derivative works of things that have used Bollinger Bands as an element of either a framework or a trading system or who knows what it might be.
Yeah, and many people simply rename them and go with that.
Right, right, yeah. Are there any favorites of yours, or what would you say is maybe the most surprising use of the bands that maybe you've come across?
Well, I'd like to answer that two ways. So I've created three versions of Bollinger Bands. The normal one, 20-period moving average, simple moving average, and plus or minus 2 standard deviations for the default. We touched a little bit earlier on exponential Bollinger Bands, which are just the same thing, but using exponential moving averages instead of the simple moving averages. And then finally, in the modern world, the trading session definition of the trading session has gone to hell in a handbasket. I mean, what's the open? What's the close? When did it? So since the first two versions of Bollinger Bands is pretty dependent on the close, you can expand that definition by using something like the typical price, the open, high, low, close divided by 4, or high, low, close divided by 3, something like that. That helps. But I also developed another technique called Bollinger Envelopes that make no reference to the open or close at all. They focus on solely on the highs and lows.
Right.
And those were designed specifically for things like Bitcoin, or Litecoin or Ether or something like that, the cryptocurrencies. And before that, the Deutschmark and such like that didn't have well-defined trading sessions. And some people argue that the cryptos, in fact, have 3 trading sessions: an Asian, a European, and an American. And you can sort of derive opens and closes from that, but I just tend to treat it more generically. And I use these Bollinger envelopes that are created by calculations using only the highs and the lows for those sorts of securities, and find that they work very well.
I suppose you're still dependent on the trading session, though, right? You still have to decide over what time are you looking for that high and low. So
for most things, it's easier to define, the broad concept of a trading session. When exactly it opens, when exactly it closes. That's for example, for crypto in 24 hours, there's really 3 opens and 3 closes. Right. But in that 24-hour session, starting in the morning in Asia and ending in the late afternoon on the west coast of America, right? That's a pretty good session definition. So we take the high and low from that session to calculate those envelopes. But if you look at it's really 3 6-hour sessions. Yeah. Right. So.
Yeah, give or take. And then it seems like with crypto, there's not
too hard to wrap your hand around an approach that has utility.
It seems like on crypto that the UTC midnight seems to be often a time used by other brokers or exchanges that are providing data as like a changeover for a day.
Yeah. So I don't like that at all, because that's actually in the middle of a trading session.
Right. It's middle of Asia, right? And I suppose it's a similar problem with most of the currency markets, right? That trade, say, 23 by 5.
Well, that's where these ideas came from.
Right.
We used to trade, the yen and the Deutschmark and the Canadian dollar and the Swissy. That's where these ideas came from.
There was a question actually that I noticed that came through, which was asking about the use of extended hours. And I suspect this is probably mainly a question around, like, say, U.S. stock, pre-open and post-market. What's your feeling on using that data?
This all started with a couple of market making firms here in California. They started making markets in listed stocks after the close. This was a long time ago. In the early 80s, they started doing this. And by the time we got into the middle 80s, they were often capturing a pretty decent slice of volume, especially in issues that had after the close announcements. They could be really active in some stocks. And it's just spread like wildfire from that. Now there's official pre-sessions and official after sessions, and some things trade virtually 24 hours a day. I have a definition that I work with. It works for me. I don't know how well it worked for other people, but I like to say that we're interested in the portion of the session where the price formation mechanism is at work, where the majority of the participants are there and paying attention and setting prices.
Right.
So, for IBM or, some U.S. stock, that's still, the New York Exchange main hours. For other things, it's other things. Is there useful information outside of those hours, yeah, but you got to be really careful about how you incorporate that information. That's still more an art than a science. And everybody's going to have a different approach as to what vendors they take that information from, how it's reported, what the volume is.
Right.
If it's stocks trading at 100 and after hours, it trades 10 million shares in the main session, and after hours it trades 20,000 shares at 105. Do you really want to pay attention to that print?
Right.
So I think it's really a complicated idea that until we shift to fully 24/7 markets is going to continue to be a challenge for traders and investors.
Yeah, no, it totally makes sense. It comes down to a quality of data question again at the end of it, right? We want to be using the best data that we can, and the data that we get pre and post is patchy at best. So I totally take your point there. On a similar mark, the question came in about using Bollinger Bands on extreme volatility asset classes like crypto, like Bitcoin. You mentioned the envelopes already. But what is your thoughts in general on these extreme volatility?
I trade volatility, and the more volatility you can show me, the better.
Right.
I don't know. I mean, I don't extreme volatility assets. I don't even like that. I don't like that phrase. So think about it for a minute. What we trade is volatility. If you knew that the price of XYZ was 90 and it was going to be 90 for the next 100 days, would you trade it? No, because there's no possibility of gain. Volatility is price change. We trade the anticipation of volatility. Of course, we want it to go in the direction that we want it to go, but that's our meat and potatoes. No volatility, no work.
Right.
So once you get to that idea, then there's more volatility. So most people, the problem is with this conversation is most people define volatility as price change that goes against them.
Right.
That's the typical definition of volatility. You buy a stock at 100 and the next day it goes to 120. You're a happy camper, no complaints about volatility. You buy it at 100, the next day it goes to 80. You're an unhappy camper and you're complaining about the volatility.
Right.
It's volatility is volatility. It is what it is. It's what we trade. It's our stock in trade. It's our lifeblood.
I've always been a fan of the higher volatility products. It just seems like more opportunity, and you can change your time frame to be that bit quicker if you need to.
You want a high volatility product. You look at some small cap OTC stock that hits the news, but holy moly. So volatility can be anywhere.
So I think I know the answer to my next question, though. Are you focusing much on crypto these days?
I am, but talking about volatility, the Swiss franc was thought to be, the classic hide in the basement asset, right? And then you get this instantaneous huge change, right? So it's what we do. Yeah, I do trade cryptos, and specifically I trade volatility in cryptos.
So by trading volatility, do you mean in what form? In in spreads, or how do you mean you trade the volatility?
I've never traded derivatives in cryptos. I just trade the cash markets, the spot markets.
Okay.
But
do you, out of interest, you mentioned relative strength before as one of the other things that you pay a lot of close attention to, and I'm assuming that is probably more of a market screening tool where you're selecting maybe the best and the worst. And so, is that what you're doing in the crypto side as well?
I'm actually getting ready to do that. I'm switching crypto providers to one that I feel will be more useful in that regard.
Okay.
Tighter spreads, less expensive, greater liquidity,
Right.
that sort of thing. And I am getting ready to run a relative strength portfolio in crypto, but right now I just trade spot crypto straight up.
Excellent. If we stick on the relative strength topic just for a second, how do you implement that for your other trading? Is it do you use that as a screening tool and then apply the bands to the markets that you've selected to try to find trading opportunities?
Yeah. Well, it can be used in conjunction with Bollinger Bands, or it can be used as trading approach on its own. If you're interested in, people are interested in relative strength, I don't know that it's the best topic for this conversation, but John Brush at Columbine wrote a couple papers that are widely available on the internet that describe relative strength calculations and such in a very rigorous and interesting way. So I think that's a good resource for people.
Great. I think that's very useful, actually. With the different methods of using the Bollinger Bands as a trading tool, do you have a favorite approach? You talk about maybe 4 different methods oftentimes, and I think the one that people probably know the best is the squeeze, because it's very obvious, especially in hindsight, to spot a squeeze and then a breakout from the squeeze. But what would be your favorite approach if you had to pick only one?
I had to pick only one. And well, I do one of the mean reversion approaches that I described in the book. I would, if I had to pick one, because those are sort of meat and potatoes approaches that generate a lot of trades, and you can put together a portfolio of trades with them and have a good result. Squeeze is much harder to trade. The opportunities are fewer and farther between. If you're talking about making money over the long term, year over year compounding of gains and such like that, then one of the mean reversion approaches would be most effective. I described one in there where if you go up and tag the upper band and one of the volume indicators like intraday intensity is negative, then that's a sell setup, and then you wait for confirmation, something like that. The reverse works as well. Go down, tag the lower band, and have an accumulation distribution oscillator like it. Accumulation distribution by Williams, for example. If that's positive, then wait for confirmation and make that trade. That's sort of meat and potatoes production sort of trading that you can build long-term capital gains that compound year after year.
Right. Very good. There's a question that's come in that I'll throw out there, since we were just talking about the squeeze a second ago. Do you see? I think I know the answer to this, but I'll throw it out there anyway. When you're in that squeeze situation, how do you tell the direction that the band's gonna, how do you tell the direction which the breakout is going to be ahead of time? Do you look at any clues ahead of time, or?
That's what traders get paid for,
Yeah.
I mean, there's no secret sauce. There's no. Everybody asks that question. Everybody wants the silver bullet, the secret sauce, the magic potion, etc. A lot of it comes from experience. You see how price winds into the coil. You see the initial breakout action. You see it's experience is really the answer.
Yeah.
And it doesn't play out the same way every time. So it is possible to develop mechanical approaches around that do work. And a lot of people have done it. There are a couple of very famous trading systems out there that are nothing more than squeeze breakouts using Bollinger Bands. Right. And I do mean literally nothing more than squeeze breakouts.
Right.
So, and people pay a lot of money for those trading systems. They could save themselves a lot of money if they would just use the bands instead.
Right. Just think about it a little bit.
Yeah.
Very good. I'm trying to go through, I'm aware of the time a little bit. We've got quite a few questions have come in, so I'm going to see if I can manage to get through a few of them. Would you mind telling us if you still prefer the default band sort of setup
I do.
parameters? So the 20 period and a 2
Bollinger Band, simple moving average, 20 period for the middle band, 20 period standard deviation times 2 for the upper band, minus 2 standard deviations for the lower band. Still what I use. I use mostly daily and weekly data.
Excellent. Here's one that we talked about briefly, but I'd like to get your read on it. What's the most surprising use of bands in general? And I don't necessarily mean financial markets. So have you come across the works elsewhere?
So there's a firm in Europe that uses them for aviation safety data. And there's a firm in China that uses them in glass manufacturing.
Right.
So, yeah, I've seen them used in a wild array of circumstances.
It would seem to make sense in manufacturing for quality control, and you can see that in air safety as well. It makes total sense now that you say it, even though it doesn't. Yeah. You wouldn't necessarily guess it.
Yeah, no, you wouldn't. No. I've seen papers that were written about those applications.
I'll give a quick. You've got a quick shout out from Sonny Harris. And it says it's
Hi, Sonny.
Reminding her of the olden days. And I know Sonny wrote a book on TradeStation. I think if I'm thinking of the right Sonny Harris.
She wrote a lot of books.
Right. Do you see if there are any? Do you have any in mind? Is there any future work, any further research and development to be done with regards to bands, or we could even just open that up to technical analysis in general?
Well, we did a really interesting thing here about 3 years ago. My daughter joined the firm, and she brought with her a very strong interest in ESG investing. I didn't really want to do it because it always comes with a performance penalty, and I've always sort of been about performance. But she was, really strong about wanting to do it. So I said, well, let's just rethink the whole thing. And so we made 2 big changes to the way ESG is normally done. It's normally done by negative screening. You take an index and you kick out the things that you don't like: alcohol, tobacco, firearms, whatever, dirty energy, so on and so forth, and build an index of the remaining components and invest in that. It's a very typical approach. So we went the opposite way. We went and identified companies that we thought were making positive impacts. So we did positive screening. We went out and picked the companies that we wanted to invest in and built a couple of indexes based on them. We call them the Impact 100 and the Impact 200. But in addition to that, I really wanted something that would deliver superior returns to investors. So we incorporated a relative strength overlay as well. That has proved to work fantastically. So we're back to rational analysis again, right? We took fundamental parts and technical parts and combined them into a superior result that delivers great returns for investors in an area where great returns are not really known about. So I think that sort of thing is the future, where you take these disparate pieces, you question the basic ideas. I always talk about first principles, the core ideas behind something. what's the core idea behind ESG? Well, you want to invest in firms that are having positive impacts. Okay, so let's go pick firms that have positive impacts. Instead of screening out the firms you don't like, Lord knows what's going to be, what the residual mess that you end up with is. So let's just turn it on its head. And, then, all those ideas were always passive, then let's just passively invest in that index. Well, nonsense. We know that relative strength works. So let's improve those returns by subsetting that index into portfolios defined by relative strength. They're going to do better than the index. So I think that really is the future, that sort of idea. And I'm really thankful that my daughter joined the firm and kicked us in that direction, because I wouldn't have gone there on my own. I'd still be doing the sort of traditional for me portfolio management that I've already done. But she really came in and reinvigorated us in that area. We created a whole new program that we do both for individual clients, and it's also available on the Access platform to investment advisors. So it's been a revolution for us, but I really should say that it's been a revelation for us. Go back to this idea that I first started thinking about in the middle 1980s of rational analysis, and bring it forward almost 40 years. And make a big success with it has really been thrilling.
I think it's fantastic, and we spoke briefly about this yesterday. The impact investing and trying to make something useful from ESG. ESG, I think, so far has been, like you said, it's been assumed that you may take a bit of a performance hit if you want to be ESG or ESG compliant. And by going back to first principles, as you say, one of the easy way to do ESG, or to say that you're doing ESG, is to go through what a bunch of the companies have been rated as, and then use a separate third-party rating agency to say, okay, these guys say that these particular companies are very well ESG compliant, and then you start your analysis from there.
So that was the issue that got us going, because
right.
we thought we were just going to build an ESG portfolio by looking at those ratings, and we noticed that for some companies we used 3 different ratings agencies, and for some companies one would have them rated as low as possible, another would have them rated mid-range, and the other would have them rated as high as possible. So we just looked at that and said, this just isn't a mature sort of first principles idea that you can rest your hat upon. So instead of doing this using the ratings idea, let's go out and identify companies that are making positive impacts, and pull things in instead of screening out using ratings.
Yes, I totally. I mean, hats off to you for doing the work, because that's the harder work, right? Is going and finding those companies that are doing the good things and creating your own index.
But it's also incredibly satisfying.
Yeah.
Right. I mean, you built something up from the ground, from scratch that's never existed before, and it's just it's a great experience, and one that I'm really happy that relatively late in my career I was able to participate in.
Yeah, and of course that must be an ongoing piece of work, right? I mean, you must be constantly.
Yeah. It's a major focus here and an ongoing piece of work.
So you mentioned the Impact 100 and the Impact 200 as indexes that you guys, I presume, are using to do that relative strength work and then turn them into an investable asset. Are the indexes themselves available anywhere? Which I guess I mean is that's the pre-screened, or you guys have done the work screening the good companies from the criteria that you're using. Is that proprietary, or is that something that you're thinking about making available?
It's not that it's proprietary. We just haven't worked with a vendor to make them available, calculated in real time, and make them available. Sort of our plan, maybe to do it at year end, but we just haven't done it yet. We calculate those indices ourselves right now, but it'd be pretty easy to hand them over to an outside vendor.
Understood. Yeah, that would certainly be great if you could get hold of it through an outside vendor platform, and then make it available on many different trading platforms that all of us could make use of, for example. Right?
Well, yeah, I agree. It's in the works.
Fantastic. Do you have any views on the current market environment with regards to we've been on this bull run for quite a long time. I'm asking the question because a fair few questions have come up in the Q&A as I'm scanning here to get your view. As do you see a correction coming? Do you see us continuing on with this bull market grind for the foreseeable until something fundamental shifts?
I'll tell you a story. Between 1981 and 1983, I apprenticed to a trader for free. Right. I kept his charts for him by hand, and I did all those calculations you saw by hand every day. And he taught me the business, which was really a great experience for me and invaluable. And in 1982, and as summer waned, Paul Volcker started cutting interest rates and gave birth to the great bull market. And immediately all of the indicators we went to maximum overbought and stayed there, just pinned to the wall. And the trader that I was working with was a guy by the name of Chuck Speth. And I looked at him and I said, "Chuck, this is madness. Shouldn't we be selling this stuff?" And he looked at me and he said a quote that I'll never forget. I don't think it was original to him, but he knew it. And he came with it just like that. He said, "The most bullish thing a market can do is get overbought and stay so."
Right.
So he turned out to be correct in that regard, and he's correct now. Again, ultimately that we'll see divergences, and we'll see a top build here, and the classic sorts of things that happen at market tops. But right now, this is a pretty well confirmed bull market. Each week, I produce a market timing chart pack. I should mention this. It's available on my main site, Bollinger, on BollingerBands.com. No, BollingerBands.com. I'm sorry, BollingerBands.com. Okay. It's available for free. I put it up most Saturdays. It's got 40 market timing charts in it, and it's just a reflection of the market timing work that I've done over the years. And we leaf through it every Monday morning here in a staff meeting, and there's just nothing wrong with it. Right. I hate to say it, but there's just nothing wrong with it. There are no real divergences at present. Everything's kind of in gear and clicking along. But at some point, maybe next month, maybe the month after, maybe who knows when, divergences will start to show up, and we'll start to get worried, and we'll start to play some defense, and we'll take some money off the table and such like that. But in the meantime, this is a bull market that we should be participating in. I mean, I understand. The other day, I posted to an email list for technicians that I belong to. I posted to a little thing that said, I'm starting to get altitude sickness, and I am starting to get altitude sickness. This stuff it's very strong, really pinned to the wall, and valuations are extreme, and price action is extreme, such like that. But I don't think it's time to quit it yet. Mm-hmm. I think we'll know when it's time to quit it. I'm not a perma bull. It's not going to go up forever. I'm perfectly willing to take money off the table. I'm perfectly willing to buy inverse funds and do all the rest of that stuff. But I just don't think the time is here for that yet.
I guess, how will your trading approach change when that time does come? So will you favor a different technique?
Just like in football, we'll take the offense off the field and we'll field the defense.
So in that way, then, do you not see a correction as a potential offensive play?
Corrections are corrections. In the old days, we thought they'd run 4 to 7%, and today maybe they run 7 to 10% or so. And corrections are corrections. They happen. Sometimes they happen frequently. Sometimes they happen very infrequently. It's just part of the puzzle. But I think people who've been around the market for a fair amount of time learn to weather corrections and to differentiate, corrections from important market tops. They're really quite different, sometimes, there are no simple answers. Sometimes, experience really counts. You look at it and you go, it just doesn't feel right. And you start digging in and you look for look for confirmation. If you can't find confirmation, then you realize you're wrong and you continue on. If you start finding confirmation for your opinion, the bottom line is that I think this is probably a good way to close. The market is always right. The analyst can be wrong. Right. But the market is always right. So if you pay attention to the market, pay attention to prices and the price structure, and the breadth data and the group and sector data, it's really hard to go wrong because the market's always going to be right. If you bring some opinion to the market, and try to force it onto the market, it's going to end up in your destruction.
Yeah.
It's just as simple as that. So,
well said.
Follow the market.
Well said. Well, John, I'm aware of the time and that we've run over a bit and we've taken up a bit of yours, and that we want to be respectful to yours and everyone's time. So I think you're right. It probably is a good spot to wrap up here. I want to thank you so much for coming and chatting to us today. I want to have a quick shout out to the guys who may have joined from your community. And if they're interested in coming or figuring out what the STA is all about, then the technicalanalyst.com website is where we live. I've so much enjoyed the chat and look forward to it for quite a long time. And I'll also just apologize just quickly to the people who have asked questions that we didn't quite manage to get to. So thank you for asking. But we've only got so much time, and we've got so much participation this time. It's been a challenge for me to try to integrate everything.
And I have a client here who wants to have a client lunch, so it's perfect timing for us. It's been an absolute pleasure chatting with you. Thank you very much for the opportunity. I'm a huge supporter of the various technical analysis societies around the world. I think they do a wonderful job. I think you guys do a wonderful job. And I'm very pleased and privileged to have been here today.
Great. Well, we feel the same, John. Thanks again. And also thanks to Dorit and Zoe. I know they're there in the background, and they've been helping us out with just getting everything set up here and organizing our chat today. So, John, thank you again so much, and have a great evening. Thank you, everybody. I can see lots of thank you notes coming through on the chat here. Thanks again, everyone. Quick bit of housekeeping. The next meeting will be in mid-December. It's the AGM. It will be an in-person meeting, and we hope to see you all there.